So your question isn't why don't you own a house? It's why are you still buying stocks instead of more property?
In respect to real estate, it's so much harder than stocks in terms of negotiation of deals, time spent, the involvement of multiple parties in the ownership. Usually when at least in the United States, there's so much more opportunity that presents itself in the security market than it does in real estate. And in real estate, you're usually dealing with a single owner or a family that owns maybe a large property they've had a long time. Maybe they've borrowed too much money against it. Maybe the population trends are against them. But to them, it's an enormous decision. When you walk down to the New York Stock Exchange, you can do billions of dollars worth of business totally anonymous, and you can do it in 5 minutes. And the trades are complete when they're complete. In real estate, when you make a big deal with a distressed lender, when you sign the deal, then you go into another phase. I mean, then people start negotiating more things, and it's a whole different game, and a different type of person, to some extent, enjoys the game.
Picture this: you're standing at a crossroads. In one direction, there's real estate, tangible, visible, something you can touch and walk through. In the other direction, there's the stock market, abstract, fast-moving, sometimes terrifying. Most people, especially those from traditional families, would choose real estate without thinking twice. But Warren Buffett, one of the wealthiest people who ever lived, consistently chooses stocks. And today, we're going to understand exactly why. Before we go any further, if you're serious about learning how billionaires think and want more insights like this, hit that subscribe button right now. This channel exists to break down the mindset that separates the wealthy from everyone else. And you won't want to miss what's coming. At a Berkshire Hathaway shareholder meeting, a woman named Jackie Hahn asked Buffett a question that probably crossed your mind too. She came from China, worked in Toronto, and like many people from Chinese families, grew up believing real estate was the ultimate investment. Her question wasn't whether Buffett owned property. It was why he kept buying stocks instead of loading up on more real estate. The answer Buffett gave reveals something fundamental about how wealth actually gets built, and it contradicts what most people believe. Buffett's first point cuts straight to the heart of the matter: speed. In the stock market, you can execute billions of dollars worth of transactions in minutes. Walk onto the trading floor of the New York Stock Exchange, or these days, open your laptop and you can buy or sell massive positions before your coffee gets cold. The transaction is anonymous, clean, and when it's done, it's completely done. No loose ends, no surprises, no one calling you 3 months later trying to renegotiate. Real estate operates in an entirely different universe. When you're negotiating a property deal, especially a large one, you're usually dealing with a single owner or maybe a family. To them, this isn't just another transaction. This property might represent their life's work, their parents' legacy, or the business they've been building for 30 years. The emotional weight is enormous. They're not thinking about efficiency or speed. They're thinking about whether they can trust you, whether they're getting enough money, whether they should have waited another year. Buffett explains that when you agree on terms for a real estate deal, that's not the end. It's really just the beginning. After you shake hands and sign the initial agreement, another phase starts. People begin negotiating additional terms. Maybe they want to change the closing date. Maybe they want certain fixtures included. Maybe a family member suddenly has opinions about the deal. In real estate, the finish line keeps moving. Compare that to stocks. If Buffett wants to buy 20,000 shares of a company and the price is right, the deal closes in 5 seconds. The seller might be someone you'd never want to meet in person, someone with questionable ethics, but in the stock market, they behave. Why? Because the transaction is recorded, tracked, and regulated. There's no room for the kind of endless renegotiation that plagues real estate deals. The completion rate for stock transactions, assuming you agree on price, approaches 100%. In real estate, agreeing on price is just the opening act of a very long play. For someone like Buffett, especially as he aged, time became the most precious resource. At 94 years old, as he mentioned in his response, getting involved in negotiations that could stretch for years makes no sense. But this principle applies whether you're 94 or 24. Your time has value, and real estate devours time in ways that stocks simply don't. Think about what happens when you invest in real estate. First, you need to find properties. That means driving around neighborhoods, meeting with agents, reviewing listings, walking through buildings. Then comes the due diligence inspections, appraisals, title searches, environmental assessments. If the property has tenants, you need to review leases, talk to property managers, understand the local rental market. If it needs repairs, you're getting contractor bids and managing renovation projects. After you finally close the deal, the time commitment doesn't end. Properties require ongoing management. Tenants call with problems. Roofs leak. Heating systems break in the middle of winter. Local regulations change. Property taxes get reassessed. If you hire a property manager, now you're managing the manager. Real estate is never truly passive, no matter what those late-night infomercials promise. Stocks, on the other hand, can be genuinely passive. Once you buy shares in a well-managed company, your job is mostly done. You're not getting calls about broken toilets or dealing with eviction proceedings. The company's management handles operations while you benefit from their work. You can own pieces of hundreds of businesses without spending more than a few hours per year managing your portfolio. For someone trying to build wealth efficiently, that difference matters enormously. Buffett highlights another critical issue with real estate. When properties get into trouble, you discover you're dealing with far more than just the equity holder. There are lenders, potentially multiple layers of debt, maybe joint venture partners, possibly tax credit investors if it's an affordable housing project. Each party has different interests and different levels of urgency about resolving problems. During the 2008 financial crisis, distressed real estate opportunities appeared everywhere. Buildings were underwater on their mortgage, developers were desperate, and prices crashed. On paper, it looked like a perfect time for someone with capital to swoop in and buy. And Berkshire Hathaway did complete a few real estate deals during that period. But Buffett noticed something important. The time and complexity involved made those deals far less attractive than they initially appeared. When a property is in distress, the lender usually doesn't want to recognize the loss immediately. Banks have regulatory requirements and internal politics. They'll drag out negotiations, hoping the market recovers or that they can restructure the debt instead of taking a loss. Meanwhile, you're in a negotiation that involves not just the property owner but also the workout department at the bank, possibly the bank's lawyers, maybe a receiver if the property is already in foreclosure, and potentially other creditors who have liens on the property. Buffett mentioned that banks recently spent 3 years reworking the loan Elon Musk took out when he bought Twitter, which became X 3 years to restructure a single loan for one of the most high-profile borrowers in the world. If it takes that long in a relatively straightforward situation, imagine how long it takes when you're dealing with a complicated property with multiple creditors and an owner who's fighting to save what they can. The stock market avoids most of this complexity. When a company is in trouble, shareholders obviously suffer, but the transaction process itself remains simple. If you want to sell, you sell. If you want to buy distressed shares betting on a recovery, you buy. There's no negotiating with 5 different creditors who all have different priorities. Buffett has watched real estate deals for more than 7 decades, and he's seen a consistent pattern. Very smart, very wealthy people get into real estate thinking they'll create an empire, and they end up in trouble. He references William Zeckendorf, a legendary real estate developer from the 1960s who was going to change the world. Zeckendorf did create significant projects, including Century City in Los Angeles, a massive development that transformed a former film studio backlot into a major business district. But despite his vision and talent, Zeckendorf's empire eventually crumbled under the weight of debt and complexity. He declared bankruptcy in 1965, then again in 1968. His story isn't unique. Real estate has a way of humbling even the most confident operators, because the business involves so many variables you can't control. Population trends shift. Interest rates change. Local economies rise and fall. A major employer leaves town, and suddenly your retail property or apartment building is in a completely different market. The leverage inherent in most real estate deals amplifies both gains and losses. When property values are rising and rental income is strong, leverage feels like genius. You put down 20% and control an entire building. But when the market turns, that same leverage becomes a noose. Property values drop, refinancing becomes impossible, and suddenly you owe more than the property is worth. You can't just walk away from real estate the way you can sell a stock that's declining. You're locked in, dealing with the consequences for years. Buffett notes that banks generally don't want to recognize real estate losses quickly, which drags out the pain. A stock that's failing shows up immediately in market prices. There's no hiding from reality. But a troubled property can exist in limbo for years, with everyone pretending it's worth more than it actually is, until finally the situation becomes undeniable. By then, even more time and money have been wasted. Here's where the story gets interesting, though. Charlie Munger, Buffett's longtime partner and the vice chairman of Berkshire Hathaway until his death in 2023, actually loved real estate. Munger did significantly more real estate deals than Buffett, and remarkably, he was doing real estate transactions even in the last 5 years of his life. For Munger, real estate was a game that interested him intellectually. Munger made his first $1 million through real estate development, not stocks. After graduating from Harvard Law School and working as a lawyer in California, Munger partnered with Otis Booth on real estate projects in Los Angeles. This was during the post-World War II housing boom, when people were flooding into California and demand for housing was exploding. Munger had an initial investment of $100,000 in his first project and generated returns of 400%. He went on to complete 5 major real estate projects in Los Angeles, accumulating about $1.4 million by the late 1960s. What made Munger successful in real estate was his approach. He focused on quality over quantity, buying undervalued properties in growth markets and holding them for the long term. He understood leverage, but used it carefully, never borrowing so much that a downturn would wipe him out. He generated both rental income and appreciation, creating multiple streams of return from each property. And critically, he knew when to stop. When he had accumulated $3 to $4 million in assets from real estate, he closed down his real estate development firm because he had achieved financial independence. But even Munger, who genuinely enjoyed real estate and made substantial money from it, would have chosen stocks if forced to pick one or the other for life. Buffett suggests that if you asked Munger at age 21 to choose between stocks exclusively or real estate exclusively for the rest of his life, he would have picked stocks in a second. The reason? Opportunity. The securities market in the United States simply presents far more opportunities than real estate does. This might seem counterintuitive. After all, real estate is everywhere. Every city has thousands of properties. How could the stock market offer more opportunities? The answer lies in volume, diversity, and accessibility. On any given day, millions of stock transactions occur across thousands of publicly traded companies. These companies span every industry, every size, every stage of development. Some are growing rapidly, some are mature and stable, some are distressed and potentially undervalued. The market constantly reprices these securities based on new information, creating opportunities for investors who can think clearly about value. Real estate markets are far more fragmented and inefficient. Each property is unique. There's no central marketplace where you can instantly see what every building in a city is worth or compare opportunities across regions. Information is harder to obtain. Many properties are owned by people who have no intention of selling, so they're not even available as opportunities, regardless of how much you might want to buy them. More importantly, the stock market offers immediate liquidity. If you identify a great opportunity, you can act on it immediately. If you later decide you are wrong, or if your circumstances change, you can exit immediately. Real estate locks up your capital. From the moment you start negotiating to the moment you finally sell, years might pass. During that time, your money is trapped, unable to pursue other opportunities that might be even better. Buffett has been spoiled by the efficiency of the stock market, and he admits it. When you can pick up the phone and do hundreds of millions of dollars worth of business in a single day, why would you want to spend months or years negotiating a single property deal? It's not that real estate can't make money. Clearly it can. Munger proved that, and countless others have built wealth through property. But for someone trying to maximize returns while minimizing time and complexity, stocks offer overwhelming advantages. Here's something most people don't fully appreciate: liquidity itself has enormous value. When you own a liquid asset like publicly traded stocks, you have options. Markets crash and you think everything is overreacting? You can buy more instantly. You need cash for an emergency or an unexpected opportunity? You can sell within seconds. You spot something significantly undervalued? You can redirect capital immediately. Compare that to real estate. Let's say you own an apartment building that you bought for $2 million. The building is performing well, generating solid rental income. Then suddenly, you identify an incredible investment opportunity that requires $500,000 in cash. What are your options? You can't sell 25% of your building quickly. You could try to refinance, but that takes weeks or months, requires appraisals and bank approval, and depends on market conditions. You could try to find a partner to buy a stake, but negotiating a partnership in an existing property is complicated. Most likely, he'll miss the opportunity entirely because you couldn't access your capital. This liquidity constraint means real estate investors pass on countless opportunities simply because their money is locked up in properties. Stock investors face no such limitation. Your entire portfolio is liquid, available to be repositioned whenever market conditions or opportunities change. That flexibility has compounding effects over time. Buffett acknowledges that some people genuinely enjoy the real estate game. Munger was one of them. These investors like the tangible nature of property, the negotiation process, the challenge of finding hidden value in physical assets. They don't mind the complexity because they find it intellectually stimulating. They enjoy driving around, looking at properties, meeting with sellers, and figuring out how to add value through management improvements or renovations. If that describes you, real estate might be the right path despite its disadvantages. Investing, like any long-term endeavor, requires sustained enthusiasm. If you hate what you're doing, you probably won't do it well. Some people find stocks abstract and boring. They want something they can see and touch. For those individuals, real estate might be the better choice, even if it's less efficient on paper. But most people aren't making that choice based on genuine preference. They're choosing real estate because of cultural programming or conventional wisdom that tells them property is safer or more reliable than stocks. They haven't really considered which approach offers better returns, more opportunities, or less complexity. They're following a script written by previous generations who may have lived in very different economic circumstances. Part of real estate's appeal comes from a perception that it's safer than stocks. Property feels permanent. Companies can go bankrupt and stocks can go to zero, but land and buildings will always be there. This reasoning sounds logical until you examine it closely. Real estate absolutely can lose value, sometimes catastrophically. Detroit has entire neighborhoods where houses sell for a few $1,000s, despite costing hundreds of thousands to build. Commercial properties in declining areas become worthless, or worse, liabilities that cost more to maintain and pay taxes on than they could ever generate in revenue. During the 2008 crisis, housing values dropped 40% or more in many markets. People lost their entire down payments and more. The permanence of physical property actually creates a problem. You can't just write it off and move on. A stock that drops to zero stops causing you pain once you sell it. A building that declines in value continues demanding attention, money, and time. You still owe property taxes. You still need to maintain it. If you have a mortgage, you still owe those payments regardless of what the property is worth. The tangible nature of real estate becomes an anchor around your neck. Stocks, despite feeling more volatile, actually offer better protection through diversification. You can own pieces of hundreds of companies across dozens of industries and countries. If one company fails, it barely affects your overall wealth. If one sector struggles, you have exposure to others that might be thriving. Real estate investors, unless they're extremely wealthy, usually own just a few properties. Their entire net worth might depend on the economic health of a single neighborhood or city. That's not safer. That's concentrated risk disguised as safety. Here's where stocks really pull ahead over long time periods: the ability to compound returns efficiently. When a stock pays dividends, you can reinvest them instantly in more shares. When a stock appreciates and you want to lock in gains and redirect capital, you can do so immediately without transaction costs eating up a significant portion of your returns. Real estate compounding is much more cumbersome. Rental income from one property can be saved up and eventually used as a down payment for another property, but that process takes years. Selling a property to reinvest the gains triggers significant transaction. Costs real estate commissions of 5 to 6%, closing costs, possibly capital gains taxes if it's not properly structured. These friction costs dramatically reduce your effective compound rate over time. Buffett understands that when you're trying to build wealth, small differences in compound rates create enormous differences in outcomes over decades. If real estate compounds at 8% annually, but involves significant time costs and transaction friction, while stocks compound at 10% annually with minimal time investment and friction, the stock investor ends up far wealthier after 30 or 40 years. The real estate investor might not even notice the gap in any single year, but compound effects are relentless. Successfully investing in real estate requires local expertise. You need to understand specific neighborhoods, local economic trends, zoning regulations, property tax systems, and local rental markets. That knowledge doesn't transfer well across markets. What you learn about investing in Dallas doesn't help much if you want to invest in Seattle. Your expertise is geographically limited. Stock investing, once you understand the principles, applies universally. The same analytical framework that helps you evaluate a retailer in New York works for a manufacturer in Ohio or a technology company in California. You can invest anywhere in the country, or increasingly anywhere in the world, without needing to become an expert in local conditions. Your knowledge scales in ways that real estate knowledge doesn't. This scalability matters enormously for investors trying to maximize opportunities. Real estate investors are limited to markets they understand deeply. Stock investors can pursue opportunities wherever they appear. If the best values are currently in energy companies, you can invest there. If technology offers better prospects next year, you can pivot. Real estate investors are stuck with whatever opportunities exist in their local market, regardless of whether those are actually the best available opportunities. So where does all this leave the average person trying to build wealth? Should you avoid real estate entirely? Not necessarily. Owning your primary residence makes sense for many people, though that's more about lifestyle than pure investment returns. Rental properties can work if you genuinely enjoy the management aspect and have local expertise. Real estate can be part of a diversified wealth-building strategy. But the idea that you should choose real estate over stocks as your primary wealth-building vehicle deserves serious scrutiny. The cultural programming that tells you property is the path to wealth isn't necessarily wrong, but it's incomplete. It comes from a time when stock markets were less accessible, information was harder to obtain, and transaction costs were much higher. Those conditions no longer apply. Today, you can open a brokerage account in minutes, invest in index funds that own thousands of companies, and do so with minimal fees. The barriers that once made stocks difficult for average people have largely disappeared. Meanwhile, real estate remains as complex, time-consuming, and illiquid as ever. The playing field has tilted decisively toward stocks for most investors. If you have limited capital and limited time, which describes most people's stocks, offer a more efficient path. You can start with small amounts, diversify broadly, reinvest dividends automatically, and let compounding work its magic over decades without requiring much ongoing attention. You maintain liquidity so you can handle emergencies or seize opportunities. You avoid the concentration risk of having most of your wealth tied up in a few properties. That doesn't mean you'll get rich quick. Buffett certainly didn't promise that. But it means you can build substantial wealth over time with less complexity and more flexibility than real estate requires. For someone working a full-time job and trying to invest on the side, that difference is decisive. When Jackie Hahn asked why Buffett keeps buying stocks instead of property, she was really asking a deeper question. What's the smartest way to build wealth? Buffett's answer reveals principles that apply far beyond just the stocks versus real estate debate. First, simplicity matters. The investment that you can execute quickly, understand clearly, and exit easily has advantages over the complex alternative, even if the complex option might occasionally produce higher returns. Complexity creates friction. Friction reduces returns, and worse, complexity consumes time you could spend on other opportunities. Second, liquidity has enormous value. The ability to act quickly on new information or opportunities compounds over a lifetime of investing. Being locked into illiquid assets might feel safe, but it's actually a constraint that costs you money in ways you may never fully recognize. Third, scalability determines your ultimate potential. An investment approach that requires deep local expertise and hands-on management limits how much wealth you can ultimately build. An approach that allows you to deploy capital quickly across many opportunities scales with your resources. Fourth, time is your most valuable asset. Investing strategies that devour time without proportionally higher returns are bad deals even if they make money. Buffett can do hundreds of millions of dollars in stock transactions in a day. Those same transactions in real estate might take years. That difference matters. Charlie Munger loved real estate and made his first fortune through property development. But even he would have chosen stocks if forced to pick one for life. That tells you everything you need to know. Real estate can work, especially for people who genuinely enjoy it. But for most people trying to build wealth efficiently, stocks offer overwhelming advantages in speed, liquidity, diversification, and scalability. The question isn't really whether real estate or stocks can make you money. Both can. The question is which approach gives you the best returns for your time, capital, and energy. For Buffett, and probably for you, the answer is stocks. Not because real estate is bad, but because stocks are simply more efficient at the core task of building wealth. You don't have to spend 8 years at Berkshire Hathaway meetings like Jackie Hahn to figure this out. You just need to think clearly about what actually drives investment returns over time. When you do, the stock market's advantages become obvious. And if you want to keep learning how the world's most successful investors think, hit that like button and subscribe. We're just getting started on breaking down the billionaire mindset. And trust me, what's coming next will change how you think about money forever.